on today. This is an exciting time, and I am really glad that you are here for this one because this promises to be something game changing, life changing. This is going to help you elevate because today we're going to reveal the wall, why the wall is there, and how you can deal with it so that you get exactly what you deserve in the area of your credit. So I'm excited to have you with me on today. We're going to get right into it. Let me ask you a question. If you've been paying your bills on time, keeping the balances low, and doing everything they told you to do, why is your credit score still sitting below 681? This is something we've got to get an answer for because for many people, that's exactly what's going on. Because the truth of the matter is you are not failing. You are being managed. I want you to hear that. You're being managed. 37 years in this system, I've watched the same traps catch the same people at the same numbers. Every single one of them thought they were doing the right thing. And honestly, they were. But doing the right thing inside a system built to work against you without understanding the rules nobody told you about, that is not a strategy. That is pure hope. And hope is not a credit score strategy. Today, I'm going to show you exactly why your score will not cross 681. Not what to do, why what you are already doing is not working. By the end of this live, you will see the three invisible walls banks built between you and 681. And I promise you, once you see wall number 2, you will never look at your due date the same way again. Stay with me. This one is going to change how you see the entire system. Now, here's the problem with how most people approach credit. They treat it like school. They study hard. They follow the rules. They do the homework, pay on time, keep the balances down, don't open too many accounts, and they expect the grade will go up. But credit is not school. Credit is literally a game. And the people who designed the game also wrote the rule book, and they left out the most important pages. I need you to hear what I just said. The people who profit from your score being low are also the people who told you how to improve it. Can you imagine that? We're making money off of your score being under 681, and at the same time, we're going to tell you how to improve it. The bank gives you the advice. The bank benefits when you follow that advice and still fall short. The bank collects the interest when your score stays in the range that cost you the most. That is not an accident. That is architecture. And today I'm going to show you the blueprint. Now, before we go any further, I need you to understand why 681 specifically. Why not 680? Why not 690? Why is that number, that specific threshold, the one that matters? That answer is coming right now, and it's going to make everything else I teach you today click right into place. Let me show you something most people never think about. When your credit score changes even by 1 point, something happens on the bank's side that has nothing to do with you. Their profit calculation changes. Here's what I mean. When you have a 580 credit score and you apply for a loan, the bank charges you a high interest rate, 24%, 25%, maybe 29%. They make a lot of money, but they also take on risk because lower scores have statistically higher default rates. So the bank builds the rate to compensate for the risk. Now, When you have a 780 credit score, prime territory, the bank gives you a lower rate, maybe 7%, maybe 9%. They make less per dollar lent, but the default risk is low. It is safe, steady business for them. Now, I want you to think about what happens in between. I'm going to say it again. Think about what happens in between. The 620 to 680 corridor is where the bank makes the most money per unit of risk. At 620, you are still in subprime. The rates are high, but people start to default and the bank absorbs the loss. At 780, you are prime. The rate is low, safe, but less profitable. But at 650, 660, 670, you are just responsible enough to pay consistently. You will not default, but your score is still low enough for the bank to charge you a premium rate. You, my friend, are the perfect customer. You pay on time every time, and you pay more per dollar than the 780 borrower. This is important. Now, if you're a business owner carrying personal credit in the 620, 680 range, your business lending costs are inflated by the same premium. Your personal profile is the filter every business runs through. Unfortunately, this corridor is not just costing you personally, it is costing your business capital access. The truth of the matter is the 600 to 680 range is the bank's most profitable zone, and specifically 620 to 680. And 681 is where all of this changes. At 681, most major lenders shift their tier structure. The rate drops, the terms improve, the fees begin to go away. At 681, the bank starts making less money on you. You understand what's going on. So, because you understand what's going on, things begin to work in your favor. 681 is not just a milestone for you. It is a profit threshold for them. And the system is designed not by accident, not by oversight, but by intentional design to keep as many people as possible in that profitable corridor. The invisible walls I'm talking about and I'm about to show you are not bugs in the system. They are the features. The features. They are designed to look like your fault while serving the bank's interests. Now, let me show you exactly how they work. This is going to help you if you catch on to this today. Wall number one is the one that gets almost every single person, and it gets them because it makes perfect logical sense. Here's what you know. Your credit card has a due date. You pay by the due date. You are not late. You think your score should reflect that, and it does. But here's what you do not know. Your credit card does not report your balance on the due date. I need you to understand what I just said because I say this so many times, but people do not yet get it. Your credit card reports your balance to the credit bureaus on a completely different date. It's called the statement close date or the statement cycle date. This is all important. And if you don't understand these dates, you suffer. And here's why this matters more than anything else that we're going to do. This is the moment that you see a statement date close. Here's what happens to the person who is doing everything right. You've got to get this. They carry a balance of $3,000 on a $5,000 card. That is 60% utilization. Huh? They make a big payment 2 days before the due date. They bring it down to $800. That is 16% utilization. Much better. And they think I handled that. My score should reflect that payment. But here is what is actually happening in this person's life. When the statement closed, the balance was still $3,000. That is what the Bureau saw. That 60% utilization The high number is what went into the score calculation. Your $2,200 payment never changed what the Bureau saw because the Bureau had already taken the picture. I got to say that again. The credit bureau takes a snapshot, a photograph at the moment the statement closes. Whatever your balance is at that moment, that is what they record. That is what scores you are going to have. And your on-time payment on the due date, that tells them you are not late, but it does not change the snapshot they already took. Now think about how the bank designed this. 2 dates, statement close date, due date. The bank told you about one of them. They made sure the due date is on every bill, on every statement, on every auto pay setup, on every notification. They made sure the statement close date is buried in the fine print or not mentioned at all. Because if you knew about the statement close date, you would manage your balance before it. And if you manage your balance before it, your utilization would look lower. And if your utilization looked lower, your score would be higher. And if your score were higher, you would be at 681 or above. And at 681 or above, they make less money on you. So they gave you one date and they kept the other one quiet. Now let me connect this directly. This is not about blame. I'm not here to make you angry at the bank. I'm here to make you aware of the system. Because here is the truth of the matter. Once you know about the statement close date, everything changes, my friends. Your behavior does not change. Your income does not change. Your discipline does not change. Your positioning changes. Same person, same dollar, same payment, different timing. And the timing is the difference between 660 and 681. The bank designed the system so that your responsible behavior still generates maximum profit for them. Once you see that, you stop trying harder and you start positioning smarter. Listen, business owners, this timing principle applies to your business credit cards and your business lines of credit too. NAV, Dun & Bradstreet, Experian Business, all pull utilization snapshots. If your business cards report high balances before you pay them down, your business credit profile takes the same hit your personal profile does. Same wall, different bureau. Now, here's where I want to talk about something I call the utilization illusion. Because the advice you've been given about utilization is not wrong, it's incomplete. And in credit, incomplete advice is almost as dangerous as wrong advice. Here's what you've been told. Keep your utilization under 30%. Stay below 30% and your score will be in good shape. That is true, sort of. 30% will keep you from being penalized, but 30% will also keep you below 681. Here's the thing nobody explains about the utilization ratio. The credit scoring model is not measuring how responsible you are. It is measuring how dependent you are. Let me show you what I mean. If you have a $10,000 credit line and you are carrying $3,000 on it, that is 30% utilization. And yes, on paper, that looks fine. But here's what the scoring algorithm reads when it sees 30%. This is important. It reads, this person uses credit regularly. This person depends on this credit line as part of their monthly operation. Now take the same person, same $10,000 line, but they're only carrying $800. That is 8% utilization. The algorithm reads something completely different. It reads, this person has access to credit, but does not need it. This person manages cash flow without leaning on the credit line. That second signal, that is what the algorithm rewards with a higher score. I got to say this again. The algorithm does not reward you for being responsible. It rewards you for looking like you do not need the credit. And there is a specific threshold where that signal changes. At 30%, you look leveraged. You look like someone who uses credit to bridge gaps. At 10% or below, you look positioned. You look like someone who has access to capital and chooses when to use it. That difference, 30% versus 10%, that is worth 15 to 25 points on your score, depending on your profile. And those 15 to 25 points are often the exact distance between 660 and 681. Now, here's where it comes and connects directly to your business, because this is where credit meets business in the CBL framework. Your personal credit utilization is not just a score number. It's a character signal. When a lender looks at your business for funding, whether that's a line of credit, an SBA loan, a term loan, they pull your personal credit as part of their evaluation. And they look at how you manage your personal credit as a proxy for how you will manage business capital. If they see 30% utilization, even if your score is decent, they see someone who leans on available credit. If they see 8% utilization, they see someone who has discipline with capital. Same credit line, same score range, different signal. And in business lending, the signal matters as much as the number. The lender is not just asking, will you pay us back? They are asking, what kind of capital manager are you? Listen, my friends, your utilization ratio answers that question before you say a single word. So when you understand that 30% does not mean you are fine, it means you are stuck, your whole approach to managing your cards changes. You're not just trying to stay under a threshold. You are sending a signal to the algorithm, to the lender, to the system. And the system rewards the person who looks like they have access they do not need. That is the utilization illusion. You thought 30% was good enough. The system knew it wasn't. This is important. Now we've got to get to wall number 3. And this is the one that hurts the most, because it happens to people who are trying to do the right thing. You have a collection. Maybe it was from a few years ago, a medical bill, an old utility bill, credit card that went sideways during a hard season. You decided to take care of it. You called, you paid it, or you settled it. You did the responsible thing. And your credit score went down, or it didn't move at all. And you sat there thinking, I did everything right. I paid the debt. I handled my business. Why is this not helping me? Here is why. This is important. When a collection is sitting on your report unpaid, it has a date, the date of the original delinquency. The older that date gets, the less impact that collection has on your score. An unpaid collection that is 4 years old has less scoring impact than an unpaid collection that is 6 months old. Time reduces the damage. Now, here's what happens when you pay it without the right approach. The moment you interact with that account, the moment you call and make a payment arrangement or make a payment, some collection agencies reset the activity date on that account. That old collection that was 4 years old suddenly looks like recent activity. The algorithm sees it as fresh, and fresh negative information is far more damaging to your score than old negative information. So you paid a 4-year-old collection, and now it looks 6 months old, and your score dropped. You tried to do something right. The system punished you for it. I'm going to say it again. You tried to do something right. And the system was designed so that doing the right thing the wrong way would hurt you. Now think about who benefits from this. When your score stays below 681, the bank continues to profit from higher rates and fees. A paid collection that resets and keeps your score down is another 6 to 12 months of you paying premium interest rates. The system did not accidentally work this way. The incentive to keep you in the profit corridor runs all the way through the collection process. Now, I want to be clear about something. I'm not here to teach you the exact strategy for handling collections today. That's the exclusion layer. That is what we build together inside the CBL Wealth Blueprint. But I want you to walk away with this thing today. Understand why. Why paying a collection without the right approach can backfire. Why the date of that collection matters more than the balance. Why the system is designed to keep you interacting with old debt in ways that keep it looking new. Because once you understand why, you stop making moves that feel right, but position you wrong. And you start to see that every one of these walls, the due date trap, the utilization illusion, the collection ghost, they are all connected by the same principle. The same principle. Here it is. The credit system does not reward responsibility. It rewards positioning. Let me say that one more time slowly. The credit system does not reward responsibility. It rewards positioning. You can be the most responsible person in the room. You can pay on time every month for 3 years. You can carry balances and pay them down faithfully. You can handle your collections when you have the money. And if your positioning is wrong, if you are paying on the due date instead of before the statement close, if you are carrying 30% instead of 8%, if you are paying collections without the right strategy, your responsibility produces almost no score improvement. But the person who understands positioning, who times their payments right, who manages their utilization signal, who handles collections with the right approach, that person's scores move. Same discipline, different positioning. That is the system. That is what nobody wants you to understand. This is important for you. But here's what nobody's telling you. And this is the real lesson. The invisible walls I just showed you, they are not just about your credit score. They're about your identity. The way you've been approaching credit reflects how the system taught you to see yourself in relationship to money. The system told you pay your bills, keep your utilization responsible, handle your debts, be responsible, and you did exactly that. But responsible is not the identity that crosses 681. Positioned is. Here's the difference. A responsible person reacts to the system. They follow the rules they were given. They hope the rules produce results. A positioned person understands the system. They know which rules serve the bank and which rules serve them. They move deliberately inside the system, not against it, through it. That shift from reactive to deliberate, that is not a credit strategy. That is an identity upgrade. But here's the truth of the matter. The people who are above 720, above 750, they're not more responsible than you. They're not working harder than you. They are positioned different than you. Same credit system, different operating instructions. And those operating instructions came from somewhere. They came from someone, a mentor, a financial advisor, an insider, a parent who knew how money actually worked, someone who told them about the statement close date, someone who explained the utilization signal, someone who taught them how to handle collections strategically. Most of us did not have that person. Most of us got the public school version of financial education, which is get a job, pay your bills, hope everything works out. That's not financial literacy. That is financial management for the benefit of the institution. And today, right here on this live, you got the right version. Now, let me show you what 681 actually opens, because 681 is not the destination. 681 is the door. On one side of 681, you pay premium rates. You get denied more often. Your funding requests get smaller, approvals with higher costs. Business credit is harder to build because your personal profile does not signal the right thing to lenders. On the other side of 681, the rate environment changes. Approval odds go up. The terms improve. Business credit becomes accessible because your personal profile is now sending the right signals. But here is the big picture. In the CBL Wealth Blueprint, we teach this sequence. Credit leads to capital. Capital leads to leverage. Leverage leads to life. When your credit crosses 681, when your profile is positioned correctly, you have access to a tier of capital that was not available before. Business lines of credit, better credit cards, SBA loans, invoice factoring at better rates, equipment financing without premium, real estate leverage. That capital deployed correctly in your business or your life becomes your leverage. And leverage, the right amount in the right place at the right time, is how you scale life without burning out. This is the life the CBL framework is designed to produce. Not just a better score, a better position in the financial system. This is important. Same person, same habits, but different positioning, and it makes all the difference. Now, if you're sitting at 647 or 660 or 672 right now, hear me clearly. You are not far, but you are trapped. And traps have keys. The 3 walls I showed you today, the due date trap, the utilization illusion, the collection ghost, understanding them is the first key. But understanding the why is only the beginning. The execution, the specific moves, the exact timing, the strategic sequence, that's the how. And the how is what we build together inside the CBL Wealth Blueprint. The link is in the description. If you're ready to move from understanding to execution, that is where we go deeper together. Listen, drop right now in the chat or in the comments, which of these 3 walls surprise you the most? Drop 1 for the due date trap. Drop 2 for the utilization illusion. Drop 3 for the collection ghost. I'm watching. Tell me where your eyes opened today. That is what I'm talking about. That is the awareness that changes everything. And do me a real quick favor. Subscribe to this channel. Hit the like button so more people can be on top of this information just like you. Share this with someone who's been stuck in the 600s and cannot figure out why. They need this today. Now, I want you to really get this. People all over this country who've been doing everything right inside the system that was never designed to reward them, that changes today. Here's what I want you to remember. The credit system does not reward responsibility. It rewards positioning. You now know what most people never know. You know about the statement close date. You know about the utilization signal. You know about the collection ghost. That knowledge is yours. It cannot be taken back. But knowledge without execution is just awareness. And awareness without action keeps you stuck at the same number. The link is in the description, and that could be your next step. Come inside the blueprint. Let's build the execution plan together. And let's do this because I really want you to be blessed. I want you to have an awesome rest of your day and an awesome week as you move beyond the walls the credit system built. Be blessed. I'll see you soon.